Hello friends, let us closely now look at the income statement format. The income statement format actually starts with the sales number as we have seen earlier. We'll take an example of a company whose sales is $1,000. When we talk about sales, we have frequently seen terms like gross sales and net sales being used often. What is the difference between the two? Essentially, when we talk about gross sales, it is the overall sales of the company without any discounts or let's say any other associated taxes which are related to sales. If we adjust this gross sales for specific discounts, the term that we get is the net sales. So gross sales minus discounts is essentially net sales. So let us term our sales as gross sales here, and let's assume that the associated discounts here is 50, so that we arrive at the term called net sales, which is 1000 minus $50, which is $950. You need to remember that sales is the amount charged for the delivery of the goods and the services, and this company has effectively brought $950 into the system. Once we have documented the net sales, the next term is the cost of sales, and we also call this as COGS, cost of goods sold. Essentially, cost of goods sold is defined as the amount paid for any merchandise sold or the cost to the manufactured products that were sold during the accounting period. What we are essentially saying is any cost which is directly associated with the sales can be called as cost of sales. Let's assume that the cost of sales was 300 and the byproduct is the gross profit. Gross profit is defined as net sales less the COGS or cost of goods sold. So what we have seen in this case is gross profit is $650. Please note that these are very important terms. Gross profit is one of the most important terms that analyst or anyone who is an investor should kind of track. After the gross profit, what we have next is the selling, general and administrative cost. We also call that as SG&A, selling, general and administrative costs. So what is selling, general and administrative costs? Selling, general and administrative costs are expenses which are closely related to the sales of the company but are not being included in the cost of sales. So these can be related to payrolls or general advertisement expenses or administrative expenses as such. Let us assume here that selling, general and administrative expenses is 200, and the difference between the gross profit and SG&A expense is EBITDA in this case. What is EBITDA? EBITDA is earnings before interest, taxes, depreciation and amortization. So whatever is the earning before interest, depreciation and amortization is called as EBITDA, and this is quite famous in analysts terminology, and they frequently track EBITDA numbers of various companies for their set of discussions and calculations. So let's calculate EBITDA. EBITDA is gross profit less selling, general and administrative expenses, and it comes out to be 450. Now the next important term after EBITDA is the depreciation and amortization. We have learned earlier that depreciation is basically the allocation of the cost of the fixed asset over its useful life. So we have learned this in detail, and I'll take some number here for the sake of example. Let's assume that the depreciation is 100. The term amortization is related to the intangible assets. Intangible assets, the cost associated with intangible assets could be that, let's say, the company has bought various patents and you may not be able to touch or feel. So the cost of those intangible assets are amortized. So we'll be discussing all these in detail in our future videos. However, for the sake of convenience, again, I'm using these numbers as it is. The next item that comes is post the depreciation and amortization from the EBITDA would be the EBIT, which is the earnings before interest and taxes. So this is earnings before interest and taxes, and we also call this as operating profit. The operating profit, or EBIT, actually represents the income from company's normal business. It is used to compare profitability of companies or divisions within the company. So it's a very important indicator, and it is defined as EBITDA minus depreciation and amortization. So here it is 350 in our case. The next item, as you can see, is this item is earnings before interest and taxes. So there are two terms left, interest and taxes. So let me jot down interest first, because that's how it comes. Interest essentially is divided into two parts. One is the interest income and the other one is the interest expense. Now interest income can actually be a part of the income statement when you will find that there are short-term investment deposits or various certificates of deposits which a company may have made, and they are earning interest on that. Interest expense actually comes when, for performing a business or buying an asset, the company may require some capital infusion, and for that capital infusion in the form of debt or loan, the company may have to pay interest. So this is interest expense, and it actually is a form of the profit and loss statement or the income statement. So here I will use the word called net, which is defined as interest income minus the interest expense. So let us now calculate the net interest expense. The interest income, let's assume here, was $10, and the interest expense associated with the loan that the company may have taken, I'm assuming these numbers to be $60. So the net interest expense is basically the difference between the two, $10 minus the $60. This reflects that this is a expense, an outgo from the firm. So here I'll use $50, and the net amount, which is the earnings before taxes, this will be essentially earnings before interest and taxes minus the expense which is associated with the interest. So we will call this as earnings before taxes. Now the next important term is taxes from the point of view of the income statement. So we have calculated earnings before taxes. So let me put this as taxes. What are taxes? Taxes are basically a financial charge that is levied by the state or the government on legal entities like business or individuals, and this is mandatory and it is punishable under law. So I mean, you cannot escape taxes, and these tax brackets are provided by the government as such. So let's assume that taxes here are around $100. So the profit after tax, we call that as PAT. This is profit after tax, is the difference between earnings before taxes and the taxes as such. So what we have now seen is that the profit after taxes is $200 for this set of company.